Hello friends, welcome to our educational channel. I am Satish Singh. Today we are going to learn about non-performing assets. NPA assets classification and income recognition. Non-performing assets are the bad loans of the banks. An asset, including a leased asset, becomes non-performing when it ceases to generate income for the bank. The criteria to identify such assets have been changing over time. Definition: a non-performing asset is defined as a credit facility in respect of which the interest and/or installment of principal has remained overdue for a specified period of time. Income from non-performing assets should not be recognized on accrual basis but when it is actually received. Objectives: the RBI introduced the NPA norms relying on the Narsimham Committee recommendations and prudential norms for income recognition, asset classification and provisioning for the advance portfolio of the banks with the intention for proper disclosure of profit and loss, and reflect the financial health of bank. The classification of assets has to be done on the basis of objective criteria and based on record of recovery rather than on any subjective considerations. The provisioning should be made on the basis of classification of assets based on the period for which the assets has remained non-performing and the availability of security and the realizable value thereof. Income recognition, asset classification norms were introduced by RBI from the financial year ended March 31, 1993. An asset becomes non-performing when it ceases to generate income for the bank, and/or becomes non-productive assets, and it can be broadly classified as given below. In case of term loan, account is treated as NPA when interest or installment remains overdue for a period of more than 90 days. For cash credit and overdraft account is treated as NPA if it remains out of order for a period of more than 90 days. An account is treated as out of order if 1. The outstanding balance remains continuously in excess of sanctioned or drawing power limit, or 2. Though the outstanding balance is less than the sanctioned limit or drawing power. There are no credits continuously for more than 90 days in the account, that is, the account is non-operative. 4. The credits during the aforesaid period in accounts are not sufficient to cover the interest debited during the same period. In case of bill purchased or discounted, it will be treated as NPA if bill remains overdue for a discounted period of more than 90 days. Coming to agricultural advances. 1. In case of short duration crops, the installment of principal or interest thereon remains overdue for 2 crop seasons. 2. In case of long duration crops, the installment of principal or interest thereon remains overdue for 1 crop season. If liquidity facility remains outstanding for more than 90 days in respect of securitization transaction, then it will be treated as NPA. In case of derivative transactions, overdue receivables representing positive mark-to-market value of a derivative contract remaining unpaid for a period of 90 days from specified due date. An account is classified as NPA only if interest due and charged during any quarter is not serviced fully within 90 days from the end of the quarter. After identification, NPA assets are classified into 4 categories in view of their status as NPA. Availability of security and factors affecting the recovery of their dues. On the basis of said classification, provisions are to be made. 1. Standard assets. These are assets which are regular in paying interest or installment and its operations are normal. 2. Substandard assets. If the loan is NPA up to 12 months, the same is called substandard assets. Doubtful assets. If an asset is a substandard asset for a period exceeding 12 months, it should be classified as doubtful asset. The said doubtful assets are further classified age-wise, that is, doubtful assets up to 1 year, 1 to 3 years and over 3 years respectively. Doubtful assets up to 1 year NPA of 24 months. Doubtful assets up to 1 to 3 years NPA over 24 month and up to 48 month. Doubtful assets up to 3 years and above NPA above 48 months. Loss assets. An asset identified by bank or by internal or external auditor or RBI as loss assets with a little salvage value. In respect of accounts where there are potential threats to recovery because of erosion in value of security or fraud by borrower, such accounts should directly be classified as doubtful or loss irrespective of period for which it has remained as NPA. Upgradation of accounts. 1. Reschedule of recovery cannot give the advance a better classification than the previous one. 2. NPA accounts can be upgraded to performing accounts, provided all overdues are adjusted or at least reduced to a period of less than 90 days. 3. Upgradation within the NPA category is not permitted, that is, doubtful account cannot be made substandard even if the overdues are reduced to less than 18 months. 4. Accounts should not be classified as NPA merely due to existence of some deficiencies of temporary nature, such as non-availability of adequate drawing power, balance outstanding exceeding the limit, non-submission of stock statements, stock statement older than 90 days temporary deficiency and becomes NPA on 90 days thereafter, subject to overall performance of conduct is satisfactory. 5. An account where the regular or ad hoc credit limits has not been reviewed or renewed within 90 days from the due date or date of ad hoc sanction will be treated as NPA. The accounts are regularized before balance sheet date by repaying overdues through genuine sources, not by sanction of additional facilities or transfer of funds between accounts. Then these accounts need not be treated as NPA. However, such classification should be handled with due care and without any subjectivity. In case of consortium advances, classification be done on the recoverability of advance in the books of account of the individual member bank. Bank needs to arrange to get their share of recovery or obtain an express consent from the lead bank. Asset classification to be borrower-wise and not facility-wise. If one facility of borrower is NPA, all the facilities of that borrower are to be treated as NPA under the same category of classification. It may be noted that if a borrower has cash credit and term loan and if one becomes NPA, both these facilities will have to be treated as NPA and classified either as substandard or doubtful or as the case of first NPA facility. Credit facility backed by central government guarantee though overdue may be treated as NPA only when the government repudiates its guarantee when invoked. Advances against gold ornaments, shares, other government securities and other securities not exempt from provisioning norms. Staff loans should not be treated NPA in less problematic cases. Loans against banks' fixed deposits, NSCs UTI, Indira Vikas Putra, life insurance policies are of self-liquidating nature and, where outstanding are within the maturity value, not treated as NPAs. The restructured substandard account would be eligible to be upgraded to the standard category only after 1 year after the date, when the first payment of interest or of principal, whichever is earlier, fails due subject to satisfactory performance during the period. In case where after restructuring the performance is not as per revised repayment schedule for 1 year, then the account will be downgraded or classified as per original repayment schedule. In case of accounts where there is erosion in the value of security or fraud has been committed by borrower, the same should be straight away be classified as doubtful or loss. Specifically, where value of security has eroded by more than 50%, account should be classified as doubtful. And where realizable value of security is less than 10% of the outstanding amount, the existence of security should be ignored and the account should be classified as loss. Provisioning norms. The provisions should be made on the basis of classification of assets into 4 different categories as stated above. That is standard, substandard, doubtful and loss assets. For standard category non-NPA 0.25%, 1%, 2% and 0.4% on gross amount in phased manner as shown in Note 1 hereunder. For substandard and NPA up to 12 months for secured exposure, 15%. For unsecured exposure, 25%. For unsecured exposure in respect of infrastructure loan, 20%. For doubtful assets up to 1 year and NPA up to 24 months 100% on unsecured portion and 25% on realizable value of assets. For doubtful assets 1 to 3 years and NPA up to 48 months 100% on unsecured portion and 40% on realizable value of assets. For doubtful assets over 3 years and NPA above 48 months 100% provisioning required. For loss assets 100% provisioning. Provision in respect of standard advances. 0.25% of gross amount for advances to agricultural and SME sectors. 1% of advances to commercial real estate, CRE. 2% of advances to housing loan at teaser rates. However, after 1 year from the date on which the rates are reset at higher rates, the provision should be 0.4%. 2% in case of restructuring accounts classified as standard advances. 0.4% of gross account for advances other than A, B, C, and D. Realizable value of security shall be include principal security, collateral security, DIG-C or CGS claim, sundry credits, net worth of borrower and guarantors, deposits as per court order and value of attached assets as per court order. For all NPA accounts, provisioning should be made on amounts outstanding less amount of interest or other charges debited not recovered by the year end. A bank may voluntarily make specific provisions for advances at rates which are higher than the rates prescribed under existing regulations, to provide for estimated actual loss in collectible amount, provided such higher rate are approved by Board of Directors. 6. The amount of liquidity facility drawn and outstanding for more than 90 days, in respect of securitization transactions, should be fully provided for. 7. In respect of NPA balance of 5 rupees crores and above, bank needs to formulate policy for annual stock audit by external agencies and in respect of immovable properties, valuation to be carried once in 3 years by approved value. Provisioning coverage ratio. Provisioning coverage ratio, PCR, is the ratio of provisioning to gross non-performing assets and indicates the extent of funds a bank has kept aside to cover loan losses. Bank should have total provisioning coverage ratio of not less than 70%. The surplus provision under PCR vis-a-vis as required as per norms should be segregated into an account styled as counter-cyclical provisioning buffer. The buffer will be allowed to be used by banks for making specific provisions for NPAs during periods of system-wide downturn, with the prior approval of RBI. Banks should not charge and take to income accounts interest accrued on non-performing assets. Income from non-performing assets is not recognized on accrual basis but is booked as income only when it is actually received. Interest on advance against term deposits, NSC, Indira and Kisan Vikas Putra and LIC may be taken to income subject to availability of margin. In the absence of clear agreement between the bank and the borrower, an appropriate policy to be followed in uniform and consistent manner. On an account turning NPA, banks should reverse the interest already charged and not collected by debiting profit and loss account, and stop further application of interest. However, banks may continue to record such accrued interest in a memorandum account in their books. For the purpose of computing gross advances, interest recorded in the memorandum account should not be taken into account. If an ME is overdue for 7 to 29 days, the indicative risk grade will be displayed as 1. Temporary irregular standard asset. If irregularity is equal to or more than one installment and the number of days in arrears is equal to or greater than 30 days, the indicative risk grade status will be displayed as 2. Problem loan standard asset. If irregularity is equal to or more than 2 installment and the number of days in arrears is equal to or greater than 30 days, the indicative risk grade status will be displayed as 3. Problem asset standard asset. If irregularity is equal to or more than 3 installment and the number of days in arrears is equal to or greater than 30 days, the indicative risk grade status will be displayed as 4. Substandard asset. Let us have a quick recap of various risk grades and their corresponding descriptions.